Do you remember? We'd spent quite some time with this manager, actually. It was multiple meetings. We were still on the fence about this manager. We hadn't decided either way, but I would say they were still in the running. And then it was almost a throwaway question at the end of the meeting, and you asked them, what is your ideal investor?
Yeah.
Do you remember this?
Yes. And I think they said an investor who gives us a check and doesn't call us, something like that.
Mm-hmm. Yep. I think that was our last meeting with them.
Our last meeting. It was our last meeting.
Hi, this is Wendy Lee, co-founder of Ivy Invest. Welcome to this week's episode of The Investment Office. As always, we're here to discuss the latest in institutional investing, private markets, and alternative assets. I'm delighted to welcome our first LP guest to the show, and a very special LP guest at that. Colin Ambrose is the Chief Investment Officer of the Mother Cabrini Health Foundation, a $4 billion foundation focused on health and health initiatives for New Yorkers with a focus on low-income and underserved communities. Prior to Cabrini, Colin was the Chief Investment Officer at UJA-Federation of New York, and prior to that, many years before that, he was the first Chief Investment Officer at the Juilliard School. Colin is a long-tenured institutional investor with a wealth of insights, but on a personal level, there is perhaps nobody who has had a bigger impact on my career. Colin, you've been a longtime mentor and a great friend. We've worked together for over 14 years. I'm so excited for you to join me here today. I'm really excited for our conversation. So thank you for being here.
Well, thanks, Wendy. I feel the same way about you.
I thought it'd be helpful to, if you don't mind, just start off by hearing more about your career background and how you came into institutional investing on the endowment foundation side.
Sure. Well, I'm thrilled to be here. And Wendy, it's been terrific working with you over the years. And I'm so excited to be your first guest on your podcast. My career didn't start in a linear way. I started in the investment world at a small broker-dealer in Hartford, Connecticut, where I was from. And then I found my way to Payne Weber, and then we were subsumed by UBS in an institutional consulting role where I learned a lot and I really loved the opportunity there. But I found the challenges were managing many accounts, and it was very hard to go deep. And the turning point for me came in 2002 when I joined my undergraduate alma mater, Wesleyan University, to work on the endowment. And that was really my first time taking a deep dive into one pool of capital, thinking long-term about how everything fits together, asset allocation, manager selection, portfolio construction. I like that model better, being able to go deep and take a long-term perspective. And that's what pulled me into institutional investing, particularly on the endowment and foundation side.
Well, that was for a time you were at Wesleyan, but then you went from Wesleyan and you were still pretty young when you left Wesleyan. And then you went from Wesleyan to being the Juilliard School's first CIO at the time. You were actually a first-time CIO, a pretty young CIO, and this was a brand new investment office that you were starting. I don't know if that many folks realize that, so I would love to hear what that experience was like now with many years of reflection behind you.
Well, first of all, I didn't know what I didn't know, but I knew I had a lot to learn. And the early days at Juilliard were both exciting and humbling. As a first-time CIO building out an investment function for a major cultural institution, honestly, I felt like I was pinching myself just to be there. And one story about that is the excellence was pervasive at Juilliard. I remember it was May of 2005. It was my final interview for the job as Chief Investment Officer. I was meeting with Joseph Felici, president of Juilliard. He's a very impressive, gregarious leader. And we had hit it off in our first meeting. I was very excited to meet with him. I had an inkling that I was the leading candidate, and I was extremely excited to go back and see Joseph. And this time he seemed to be rushing me out the door. And I left the meeting a little harried, wondering, geez, did I misread things? I wonder what happened. And then later I learned he was hurrying me outside because Mick Jagger and the Rolling Stones were on their way up and they were going to be playing on the balcony outside his office. And he wanted the space cleared before I arrived. So the lesson there was there was greatness all over the building. You never knew what was going to be outside your door. And I realized very quickly that, I was very privileged to be in that situation.
Well, I suppose to be followed by Mick Jagger, that's that's a pretty good following act.
Yeah. And so from a perspective of what it was like to be there, I realized that I didn't need to be the smartest person in the room because I never would be. The job was really about judgment, asking the right questions, making thoughtful decisions with imperfect information, and really collaborating. I learned very quickly that it didn't really matter what my best idea was if it didn't align with what the committee chair and the committee's risk tolerance was. So I learned very quickly to be a collaborative investor, and I think that's served me well over the years.
I really want to talk about sort of that comparison point between how it felt when you were starting Juilliard, the lessons that you had learned, that experience of starting an investment office at Juilliard, where to your point, you didn't really know what you didn't know.
Right.
And I really want to compare that to what that experience was like for you so many years later, back in 2018, when we were starting the investment office for the Mother Cabrini Health Foundation. Obviously, very different institutions, a very different situation, Mother Cabrini Health Foundation, which was a brand new foundation. So a lot of things being built out at the same time as compared to the Juilliard School, which is long tenured, established, enormously influential cultural institution. But from your experience as coming in, building out one investment office, and then many years later doing it again in sort of that wholesale, whole cloth sort of way, what were some of the things that you took away from your repeat investment office building experience? What were the things that you experienced differently, other than obviously you had a lot more experience on your hands coming in for Mother Cabrini Health Foundation?
Yeah, I think being the first CIO at both Juilliard and Cabrini, as well as at UJA-Federation, taught me that every startup is different. At Juilliard and at UJA, I inherited a portfolio that already had been built, and I had to build the investment office from scratch. At Cabrini, we had a blank canvas, as you know, Wendy. We had 3.5 billion in cash and the opportunity to design the portfolio and hire a full team from the ground up. Juilliard was a 100-year-old institution with an established culture. Cabrini was a de novo organization with cash. Juilliard, it was essentially just me for most of the time. At the end, I'm very proud of the people like yourself who I hired along the way. Hired Kathleen Jacobs, who since went on to become a CIO herself, just like you. And at Cabrini, I've built a small team. There's 9 of us on the investment team, and we were building the portfolio and the team simultaneously. And despite the differences, the fundamentals are strikingly similar. All 3 institutions strive for excellence. They all have clear missions and are supported by talented, engaged board members. And really, in all cases, the challenge is making high impact decisions under uncertainty, structuring governance effectively, and creating an investment framework that can endure over time.
So one of the eye-opening things about leaving the endowment foundation world to come and build Ivy Invest, there have been so many eye-opening things to go from institutional investor to startup founder, right? But one of the really eye-opening things has been that I've come to realize that there is a lot of both fascination and speculation about how endowments actually function, how endowments invest, how they make decisions. And I think part of it is because, as you and I both know, when we're in these investment offices, we're sort of just in our bubble. We're just doing the work, right? And so I realized that there aren't a lot of us who have gone on to talk about what endowment investing actually looks like, with some very limited but notable exceptions. And so what has ended up happening is that I think a lot of folks who've never sat in our seats have gone in and then filled the empty space. And so there is a lot out there, a lot of, I will say, assumptions out there about what endowment investing looks like and how endowments invest. But I'm curious to hear from you, because I've had to articulate it a lot since starting Ivy Invest, and I've had to really think on it. But I'm curious to hear from you. How would you describe endowment investing? A lot of folks just associate endowment style investing with a ton of alternatives and privates, and that's just the thing, that's just the move. And I'm like, that's the outcome, right?
Yeah.
That's not the intentional, that's not the philosophical approach.
Yep.
It's not the underpinnings of what we do, right?
Yeah. I think at its core, the endowment approach is about sticking to your knitting and knowing your competitive advantage. So it's diversification, discipline, and focus, not FOMO, not chasing every idea that comes your way. As Wendy knows, I love to say terrible analogies, but this is not gymnastics. There are no extra points for complexity or degree of difficulty on an investment. At the end of the day, I think it comes down to one key question. How will this idea make us money, and what are the consequences if we're wrong? A lot of people look for really esoteric, quirky, unique ideas, and those are fantastic. At the end of the day, if you can answer the question, how is this going to make us money, and what are the consequences if we're wrong? And a lot of times, those complex ideas are complex and hard to execute, and you have to really make sure that you're getting paid appropriately to take on that additional risk.
But I think that's exactly it, right? We think so much about how are we compensated for the risk that we're taking, right? And risk assessment from an endowment standpoint looks at a wide variety of risk, right? It's not simply like risk is measured by volatility or risk is measured by drawdown risk. There are a lot of risks that we think about, actually, Colin. I'll sort of throw this back to you. What are some of these other risks that we do think so much about? And we talk a lot about, especially, I think you and I especially, we talk a lot about uncompensated risks too.
Yeah, uncompensated business risk. I always love when somebody's founding a new firm to be early investors. There's a lot of rewards that accrue to early investors, but it's very different to start a firm and build a team from scratch while you're managing a portfolio. And oftentimes, those early returns come with many bumps. And we all know, another analogy, 50% of restaurants fail within the first 2 years. So if you only go to restaurants that have been around for 3 years, well, you're going to restaurants that are probably going to be in business for a while. Same thing with fund managers. A lot of fail within the first couple of years. So there's a little bit of hubris in thinking that you can back the ones that are going to perfectly be in business. Now, there are pedigrees that you want to back, and we have successfully backed day one investors in the past, but they typically were folks that we were invested with in other firms. We have a long-standing relationship with them. We already pre-identified if this person were to leave their firm, they'd be somebody we would want to back. And we do a tremendous amount of due diligence on them. And sometimes the most gratifying part of the job is to not back those managers, but be there day one, talk to them, let them know what you're looking for, and then invest with them several years later. So taking uncompensated risk is not what we're paid to do. And the other risk I like to think about is not the probability, but what are the consequences of the probability. As an institutional investor, in a venture portfolio, we can stomach a zero in an individual portfolio company or several zeros as long as we have those home runs. If you back a manager that fails, it's really challenging from a perspective of your committee's confidence in you as a chief investment officer, as a staff. If you have too many of those failures early on, they're not going to think that you're a good enough investor to entrust with their capital.
Mm-hmm. Yeah. And I think a lot about the ways that we think about if we're going to take a risk, we need to be compensated for that risk, right? So it comes across in both the ways that we think about investing. If we're going to invest in something that is, let's say, a 10-year lockup, it can't deliver the same returns as something where you're getting daily liquidity. Like it has to be able to provide a premium to that, right? So just to your point, there's no extra points for complexity.
Right.
If someone is executing a highly leveraged, really complex strategy that has the potential for, big gap out risks or big drawdowns, that we're going to put a very different return premium on versus, right, a straight way long equity investment.
Right.
And I think that's so key to how endowments think about the world. And that's ultimately why endowments and foundations do happen to invest in some offbeat places, right? In alternatives and private markets. They were early to international equities and emerging equities. They were early to private markets, venture capital, but not because they were these, alternative investments, right? It was more, there were risks they were taking. They recognized the risks they were taking. They were being compensated for those risks they were taking. The sort of flip side of that is I think there has been not a lot that we as endowment investors share. And again, it's sort of been left to others to speculate. I think a lot gets assumed about endowments foundations, and a lot gets extrapolated from the little information we do share. And so what we've seen in recent years, I think, are more folks questioning the endowment approach of seeking a broadly diversified portfolio, seeking investments that are non-correlated to one another, seeking different streams of returns. But as a consequence of that, in a market environment where public equities have generated mid-teens, double-digit returns for many years on end now, which we could talk about separately,
Right.
it's led to this criticism of the endowment style portfolio and whether the endowment style portfolio continues to hold up. And so I'm going to, play devil's advocate here and pose that question to you. But does the endowment portfolio and approach still hold up?
I think it does. I think the endowment approach still holds up. It's not just about stocks and bonds. What makes it different in my mind is diversification, flexibility, and access. Endowments can invest across public and private markets. We can take a long-term view and seize opportunities most investors can't. And it comes down to using your competitive advantages, which I think are scale, patience, stable capital, while sticking to a disciplined process. And the goal, as you know, Wendy, isn't short-term performance. It's strong risk-adjusted returns over decades. And that combination of flexibility, discipline, long-term thinking is what makes the endowment model enduring.
And it certainly will be enduring should we go through a prolonged period, which I don't know. Who knows when that day will come? But I have to think, having done this, for as long as we have, that there is going to be a day
Right.
when the 10-year return on the S&P is not mid double digits. I think folks forget that there are, 10-year periods where the S&P generates negative returns, and
Absolutely.
that's a very uncomfortable period to be in with a purely stock or stock bond portfolio. And endowment portfolios, I think, are a recognition of the fact that we don't know the future. We don't know where markets are going to go.
Right.
And so a diversified portfolio is prepared for many scenarios. This is something which I think is a bit of a sensitive question. And so we can see where this takes us. When we built out the team and when we built out the investment office at Mother Cabrini, and when you were looking to build out the team at UJA-Federation or at Juilliard prior to that, I'm obviously honored to have been your first hire at UJA-Federation. But when we talk a lot about what makes for a good investor, what makes for a good endowment investor specifically, and I think you and I have noticed that there are certain trainings that differ depending on the institutional investor background that someone might have come from. And so, I'm curious, given your experience in hiring many folks over the years, what learnings do you think endowment offices specifically teach well?
I think endowment offices teach you lessons you don't always get everywhere else. I won't say that you don't get them some other places, but not always. And I think it starts with long-term decision making. We're not making decisions at an endowment for the next quarter. We're thinking about multiple year periods, even decades. And I think that's really key. Second, I think diversification and patience, spreading risk, sticking with investment strategies through cycles, not worried about month-to-month returns is also very important. And I think endowment style investing teaches you to play to your advantages. Again, it's scale, it's access, it's flexibility. Instead of chasing every single idea that comes by, sticking to your knittings. And I think above all, endowments and foundations do a good job of emphasizing a repeatable, disciplined process. So asking the right questions, evaluating rigorously, making thoughtful decisions with imperfect information. These are lessons that you can learn at other places, but I think it's the core of what you learn out of the endowment.
Yeah, I totally agree. Given the many folks that you've hired over the years, what do you look for an investor when you're looking to add to the team?
I think when I look for somebody who is intellectually curious, somebody who is humble, strives to learn, and is focused on more process over emotional investing, and somebody who has the ability to be patient and is comfortable working in a team atmosphere. I want somebody who is thoughtful on their own, but really is focused on being part of a team and not being an individual maverick where they're focused on a silo investing that they only know their one thing and that's all they focus on. So as you know, Wendy, I like to have an approach where people are, for the most part, generalists and overlap each other, or maybe they have a major and minor subject that they focus on, but that they are more comfortable collaborating with each other than being a maverick and going their own way.
Yeah, I agree. And I think this is actually something we've talked about previously, which is I think it is a disservice for young investment professionals when they're asked to specialize too early on in their career.
Right.
I think one of the things that I greatly benefited from was that I started in this business back when everybody was a generalist. And I think over the years, as investment offices have grown, if there have become so many more investment offices, we've seen that a lot of folks get hired in and they get trained up as specialists in one particular area of the portfolio. And I think, ironically, it's a short term decision that's being made by that investment office because, yes, it is really nice to have sort of plug and play ability in any one asset class. But over the long term, I think an investment office and an endowment office is better served when you have, to your point, a group of investment professionals that do have a more generalist lens that can think about what makes sense for the entire portfolio, where any given investment is evaluated and is a competition for capital across different asset classes or investment opportunities, right? Like we talk about this, like, for instance, let's say like we talk a lot about, if you were interested in investing in one region, for instance, you don't know necessarily going in whether you're going to invest in that on the public side of the portfolio or the private side of the portfolio.
Ready for another bad analogy? If all you have is a hammer, everything's a nail. So you need
Bring it, bring them.
so you need people with different tools in their toolkit who, so for instance, biotech, if you're a private equity investor solely, you may think the only way you should access biotech is through the private markets. There may be times when you want to be a public markets biotech investor. So you want somebody to say, yes, biotech's an interesting place to invest. Do we want to do it in public or private? If you're siloed and all you think of is private, well, we know the answer. You think you should only invest in biotech and private, when there are times when you may actually want to access it in the public markets. And if you're siloed, you won't have that perspective.
Yeah, exactly. It's that competition for capital that keeps everybody honest.
Right.
So you talked a lot about process, and we always talked a lot about process in the office too. We talk about process versus outcome. So tell us, what do you think makes for a good investment process?
I always focus on process over outcome for sure. And I think a good investment process is repeatable, it's disciplined, and it gets the little things right. It's about having a clear framework, paying attention to details, doing the right things for the right reasons, never stretching in strong markets or panicking in weak ones. You can control the risks you take, but you can't control the results. So if you stick to a thoughtful, consistent process, good outcomes tend to follow.
What does the flip side look like if you lose discipline and you forget to focus on controlling the risks that you take and you get a little loosey-goosey in your underwriting? Like what are some of the potentially negative outcomes that you've seen happen when folks forget about that discipline first?
Well, I think that a good example of that is some folks did this in right prior to the dot-com bubble. Some value investors were getting crushed and capitulated and started buying internet stocks right before the crash, much to their chagrin, and it was based on FOMO. Um, that's an example that comes to mind, and I've seen it in terms of some of the red flags that sometimes I've seen in managers are managers who don't stick to their knitting, who will, when you're talking to a manager and you ask them why they own a particular security, typically they have a repeatable process and there's some sort of edge they feel they have in identifying the value of that security that the market is at odds with. But occasionally you hear them make a comment that It's too big not to own. And those are sort of the red flags of they're not really doing fundamental research or any analysis on why they should own the security. They just, again, it's a FOMO, or they feel that they need to own that security because their competitors are owning that security. So those types of situations I don't think end up working out well, because that is outcome oriented. They're worried about what is the return of that underlying security, and that's the only reason they're owning it. It's because it's generating an attractive return, and they don't really have any edge in an analysis basis on the underlying security, but they're owning it to not miss out relative to their competitors. And when I hear that, it's a situation where I do not want to invest with somebody who has that type of FOMO strategy.
Mm-hmm. Maybe just moving slightly away from that, what do you think, what can individual investors, given all that we've talked about so far in terms of how institutional investors think about their investment frameworks and risk frameworks, what can individual investors learn or take away from how institutional investors think about portfolios?
I think the biggest key is to be focused, disciplined, process driven. Again, focus on your process over emotion. Patience is a virtue. Avoid FOMO, chasing the hottest investment out there. And at the end of the day, we talk a lot about outcomes, but if I'm very comfortable with making mistakes, following the right process. In other words, knowing the same information ex post, would I do the investment again? And if the answer is yes, I'm very comfortable with it. Sometimes you miss things in your process, but those are the kinds of mistakes that you should be able to correct. What I think that some individual investors can fall into the trap of mimicking other folks' investments, not understanding why they're making the investment, just chasing something that has generated good returns, or because it's popular or somebody they respect is invested alongside that.
Okay, I'm gonna switch gears here because I do know that I have folks who are on the GP side who listen here. So you've talked about the types of red flags, some of the red flags that you have observed from GPs, but what about green flags? What does a good LP GP relationship look like? What does a good what does a good relationship between an institutional investor LP and an investment manager GP look like?
I think a good GP LP relationship is built on trust, transparency, and alignment of incentives. The GP needs to communicate openly about strategy, performance, and risks, and the LP needs to give the GP the space to execute without micromanaging or questioning their judgment. And really, in short, the best GP LP relationships are partnerships. They're not just transactions. Again, thrive on clear communication, mutual respect, shared goals, and alignment of incentives.
This, I think, is really important because I think for individual investors, it's more difficult to envision what this actually means. Because as an individual investor, when you're making investments, they're entirely transactional, right? Whether it is buying an individual stock or bond or buying shares of a mutual fund or an ETF, it's entirely transactional. There's no building of a partnership or a relationship with the manager of that investment. And so it looks just so wholly different for institutional investors. We ran a survey before we launched IB Invest, and we surveyed a number of individual investors, and we asked them what they thought was most important. We gave them like 5 choices, like, what do you think is the most important down to the least important factor that you consider when you make an investment decision? And without fail, individual investors who were not in our line of work, the bottom ranked factor, the least important factor to them, were the people overseeing the investment. And for the folks, because we included friends in this survey, those friends who work in investments or are institutional investors, we know that that is the number one most important factor in our decision making is the people and the people that we're investing alongside. And so that to me was just like a very eye-opening difference in responses in how individual investors gauge the value of the people behind what they're investing in.
Yeah, it's all a people business. I mean, if you don't trust the people, you're not going to get good results.
Yeah, right?
Right.
And it's easy for us to say that because we know when we actually take the time to get to know people, it's not an option that's available to individual investors. And so I think it's just one of those, it was one of those big gaps that I was, again, we're in our bubble. When we're in our bubble, we don't think about it.
Right.
Um, on the reverse side, what are some red flags you've seen over the years
Yeah,
that tell you a GP is not going to be a good partner?
red flags usually show up early. And so the good thing about that is if you do good due diligence, a lot of times you can suss out the red flags and not even invest. Occasionally, either people change or you miss something, but typically red flags I see, and a lot of times this shows up before you invest, so you avoid investing, but is lack of transparency. So when you're talking about the strategy or how they've generated returns in the past, where they're loath to share. I'm not actually asking for their trade blotter, but they're loath to share how they made returns or what their thought process was in individual security selection. I think another big one for me is hubris, or again, straying from their expertise to chase returns. Seen that over the years where people morph their strategy. Sometimes it's at a multi-strategy shop where they're adding folks in different areas, and it's very compatible with their existing skill set, and that makes sense, but not in all cases. Another red flag is misaligned incentives, and we see that sometimes in the way performance or carried interest is structured, where it's unfair to the underlying investor. And then inconsistent decisions are their warnings, where and this is something you suss out in pre-due diligence, pre-investment, or you start learning over time. If presented with the same facts, they make different decisions. Some of that is growth and learning if they're not repeating the same mistakes. But I've come across examples where sometimes a manager will pile into a particular stock, and then the next time they don't. And when you ask them or challenge them on their thinking process behind that, it doesn't really hold water. And it seems to be somewhat inconsistent or random. And again, it's not outcome oriented. It doesn't matter whether that it was the right decision or the wrong decision. It really matters, is that a repeatable process? Because it's somewhat random if they get it right or wrong. If they're not following the same process, it's hard for me to underwrite their strategy if I don't understand why they're doing what they're doing.
Okay. Do you remember when we'd spent quite some time with this manager, actually? It was multiple meetings. We were still on the fence about this manager. We hadn't decided either way, but I would say they were still in the running. And then it was almost a throwaway question at the end of the meeting, and you asked them, "What is your ideal investor?"
Yeah.
Do you remember this?
Yes. And I think they said an investor who gives us a check and doesn't call us, something like that.
Mm-hmm. Yep. Think that was our last meeting with them.
Our last meeting. It was our last meeting. I also had a meeting earlier in my career where I was asking, I thought the typical due diligence questions, and the manager was getting increasingly frustrated and made some sort of a snarky comment like, ask your questions now, because once you're an investor, you won't get me to answer these questions anymore. And I said, okay, I probably will never become an investor then. It was very interesting.
I'm going to move to some rapid fire questions. What is your favorite due diligence question and why?
So I like to call an audible depending on how the conversation is going. Having said that, there are.
You love to throw managers off their game.
I do. I don't like to go through, as Wendy knows, I don't like to go through a pitch book. I like to ask a question as it pops in my head. I have the core of where I know I'm going when I'm talking to managers. But if they say something interesting or something I want to pursue further, I go for it. The problem with stock questions is because they're stock questions, managers are prepared for those questions, and the what keeps you up at night, and they're going to talk about the risks in their portfolio. But what I like to do is pivot a little bit on that type of thread and say something like, why should an investor fire you? And that throws them off a bit. A confident investor will say, well, they should fire me if I don't stick to my knitting, if I'm no longer investing the way I've laid out my strategy drift, or they'll give some sort of a reason that makes sense. And the reason it's good to hear their perspective on that is, one, have they ever thought of that? And two, if they do stray from their knitting, it's very easy then. I have no problem having difficult conversations, but it's very easy for me to point to that and say, hey, when we were first hiring you, we talked about reasons why we should fire you. And one of the things you brought up yourself was, if I stray from my investment strategy, and right now I feel like you're very much far afield from your strategy, and those kind of conversations tend to go well later. I also like to ask any mistakes or lessons learned. Usually get some really good lessons learned that I can take back to my career and my in managing my team and my thinking on investing. Occasionally you get somebody who really has trouble articulating that they've made any mistakes, and that's a way to somewhat suss out hubris, or maybe not hubris, it could be hubris, but really a lack of self-reflection.
I was going to say, or maybe they just haven't been doing this long enough, because
Right.
there is no way you've been investing for a long period of time without making mistakes.
Right.
So I will actually ask you this question.
Yeah.
When you reflect back, what's a mistake or a lesson learned that you take with you?
Yeah. Fortunately, there haven't been a lot of huge mistakes. I've definitely made mistakes, but I think that the one that is the most obvious to me is, once you lose confidence in a manager, you should get out. Don't wait until you find a better idea. Just punt. Every investment has a cost of capital. What I'm really referring to is, there was a hedge fund manager we had in the portfolio many years ago that was sort of doing a mediocre job, had generated long-term, really strong returns. There were slight changes in process creep, some things that on face value, I could understand their rationale for all these changes, but it really had morphed a bit from how we originally underwrote the manager. And in my mind, I thought we could find somebody better. And we did ultimately get out of the manager. We didn't lose money, but we didn't generate as much return as we could have if we decided to exit once I started to realize I lost confidence in the manager.
Yeah. Yeah. That's a really important one that I take. That's actually one of mine too, is that, yeah, sometimes making that decision sooner is better than later, because the cost of capital is a real consideration.
Right.
What's a favorite investment you've made over the years?
Well,
Just a description.
Wendy,
Please don't name the manager.
as a mother of three children and me as a father of four kids, you can't have a favorite child, but they're all my favorite at some point, and they're all in the penalty box at some point. But all kidding aside, I think my favorite investment is one that I know you would know who they are, and it's not obvious, but it was a real estate manager whom I had backed at a prior organization, and we made an investment at UJA. And it was a time when it was a particularly challenging time in the real estate market, and it ended up being a great outcome. From the time we invested to when we exited, generated very strong returns. But what impressed me about this manager is, we invested, and it was a very bull market. The strategy was more long short REIT type strategy, and the manager closed the fund and gave capital back simply because they recognized that the opportunity set had moved away, meaning it was too frothy. They were having trouble finding good investments at those prices, and they could have continued to manage that fund because they had generated such tremendous returns and collected fees, but they walked away because they just thought the strategy wasn't suitable to be invested right now, and that to me says a lot about the character of the managers. You try and align with good people who are ethical and are doing the right thing for the right reasons, and have a strong alignment with their LPs. From a GP perspective, they could have milked that and managed the fund for several more years, and instead they gave their capital back, and that was a big lesson to me, that about character, and the outcome was terrific. But I just thought more so that they actually gave capital back when they didn't have to, and that's very unusual, as you know, in our business.
Oh, yeah, it really is. They could have milked that for some years going forward.
Yep.
And I think even we were surprised that they were making this like the entirely correct decision, right? This entirely aligned decision. Thank you so much for joining us this week, Colin. I had such a great time, as always, chatting with you. So thank you so much for being here.
Thanks, Wendy. I enjoyed it too.
The Investment Office is presented by Ivy Invest Corporation. Ivy Invest Corporation serves as the advisor for the Institutional Investment Strategy Fund, a closed-end interval fund. The fund is designed for long-term investments and is not intended as a complete investment program. An investment in the fund may not be suitable for you if you will need the money you invest within a specified time frame. Shares in the fund are illiquid and can be sold by shareholders only in the quarterly repurchase program of the fund, which allows for up to 5% of the fund's outstanding shares at NAV to be redeemed each quarter. Before investing, you should carefully consider the fund's investment objective, risks, charges, and expenses. This and other information is in the prospectus and summary prospectus, a copy of which may be obtained by visiting fund documents at ivyinvest.co. Please read the prospectus carefully before investing.